And I think that's where things get really exciting then because you get kind of massive compound effects then.
It's huge. Yeah, the compound works both ways. So there's obviously the growth, but you're hindering yourself if you're taking that massive tax hit straight away.
Yeah.
You're fighting with your arms tied behind your back. And
Yeah.
sometimes you just need to, because it does get complicated. Sometimes you just need some joined up thinking with someone like ourselves and
Yeah.
some accountants like yourself, just to make sure it is the best option. So a general overview, an ISA is an allowance that you get every year. You get £20,000 and you can put your money into a cash ISA, which will be invested or not invested, which will be held in cash. Or you can have a stocks and shares ISA, and you can, as I mentioned, put 20,000 in every year, and you can accumulate that over the years to kind of build wealth in a tax efficient manner. And it just
Yeah.
means any growth within that ISA isn't
Yeah.
subject to capital gains tax, isn't
Yeah.
subject to income tax. So it can be quite an efficient tax vehicle. Now,
Yeah.
and it aligns with the tax year. So you've got a £20,000 allowance per tax year. But
Yeah.
once the tax year is over, you can't go backwards. So if you didn't use the previous
Yeah.
ISA allowance, then it's gone. It's off
Use
the
it or
table.
lose it.
Exactly, exactly.
No. So I
Um,
think that can, initial reactions there, that can be actually kind of quite appealing, particularly now we've got a regime where capital gains taxes are going up and up more, and we've now no longer got any meaningful level of CGT free allowance every year. So basically everything you sell is subject to more and more tax. And, that's really kind of ratcheted in over the last 2 or 3 years. So it's kind of bubbling through as a really appealing kind of wrapper there, I suppose.
yeah, it's really attractive. If it makes sense for you to use one, then it is attractive, because obviously you get tax free growth.
Yeah. Cool. Okay. So is it the case that all dentists should absolutely be maximizing this? I've probably got this preconception that it's almost like IFA rule number one is make sure you're using your ISA allowance every year. Would that be kind of accommodating advice for dentists as well?
It's a really great point, and the more most of my clients, it would actually be no, which would be quite surprising. And that's because usually they'll pay themselves for a limited company, whether they own a practice or they're an associate. And
Yeah.
usually they'll either be trying to keep below the 50,000, just over 50,000 threshold, so they don't go into higher rate tax, or that
Yeah.
£100,000 threshold when they really get hammered and lose their personal allowance and
Yeah.
have an effective rate of around 60%. So what I've had some clients doing when they've come on board have said, well, I've been pulling money out to put it into my ISA, and when we've been actually looking at it, they've been getting massacred at that 100,000 mark,
Yeah.
just to put it in a vehicle. So it's kind of led them to do something which isn't optimal. And in that case, in those scenarios, what we can do is we can just invest within the limited company,
Yeah.
and we can structure the investment so that they're income producing.
Yeah.
And if there's something what we call equity funds, they have to have a certain amount of equity within the fund. By
Yeah.
equities, I mean companies, stock shares, it's
Yeah.
the same thing, to pay dividends into the company. And
Nice.
as long as it's a UK based fund, then those dividends aren't subject to corporation tax. So
Wow.
it's a really tax efficient way of building up wealth within the company.
Yeah.
And again, if you are transitioning to retirement, you could use some of that for pension, but you could also build up that fund within the limited company. And if you
Yeah.
stop working, you could then draw down from that fund and pay yourself dividends.
Yeah, wow. Okay. So if I kind of go back to the basics there, because I think there's this kind of the danger is you kind of have these paradigms as well. So maybe if I kind of throw some numbers at it, if you've accumulated, for argument's sake, £20,000 worth of surplus in the year in your company, and we always recommend you should explore limited companies.
Yeah,
Well, to get that £20,000 out, it might cost somewhere between £8,000 to £12,000 worth of tax, depending on your
yeah,
rate. And then, yes, then you get to put that residue in your ISA, which is then tax efficient. But, think paraphrasing what you say is the trouble is it's really tax inefficient to get the money to put it in there in the first place. Would you
yeah.
rather have £10,000 worth in your ISA, or would you rather have £20,000 worth in an investment account in a limited company? And I think that's where things get really exciting then because you get kind of massive compound effects then.
It's huge. Yeah, the compound works both ways. So there's obviously the growth, but you're hindering yourself if you're taking that massive tax hit straight away.
Yeah.
You're fighting with your arms tied behind your back. And
Yeah.
sometimes you just need to, because it does get complicated. Sometimes you just need some joined up thinking with someone like ourselves and
Yeah.
some accountants like yourself, just to make sure it is the best option.
Yeah, what we can find quite often is that, the immediate question will be, well, hang on, aren't I going to have to pay tax to get that money out in the future? And it's not that straightforward though, because the answer might be, but you might not want to, or when you do, your tax rates might be different. Or when you do, you might be living overseas in a, more favorable jurisdiction. There's many kind of other elements that might be kind of relevant. And actually, what we're seeing, happening a lot more often now is people considering kind of intergenerational planning. And so that's actually kind of surplus wealth to them that they're factoring into future IHT planning. So everything kind of, well, you just got to kind of grab every percentage point you can. And yeah, the contradictory part, which I know will be kind of quite abrasive, I suppose, is that ISAs can actually be a really, really terrible thing to do if it's cost you eight to £12,000 worth of tax to start it up in the first place. Is that, do you think that would be, what would your kind of fellow IFA colleagues kind of say about that?
Yeah, I think they would. I think they would agree with me once they look at the detail.
Yeah,
And I think it's like you've just got more options. The more money you've got, the more options. It might be with a limited company. You could look at a family
yeah,
investment company at some point in the future when you've worked out how much you need. You
yeah,
can make additional pension contributions, and then as I say, you've got a war chest there. If you build that up over a career, 20,000. You manage to put 20,000 a year in for
yeah,
a decade, 2 decades. That's a big amount of money which you can draw
yeah,
down from. And then you could draw some dividends from your limited company when you're not working. You could take a little bit from your pension,
yeah.
and you could do it in the most tax efficient option, tax
Uh,
efficient manner.
I think what I'm hearing is there's no substitute for a kind of careful and well thought out plan with tax advice that kind of dovetails into it.
Yeah, definitely, definitely, and it's often overlooked because it seems like the right thing to do, and I think it's that herd mentality as well. Everyone knows the ISA, and there's a lot of
Yeah.
marketing about ISAs, and I think it kind of catches a lot of people out.
Well, I mean, I hope this is very, very useful. I think it'd be extremely useful for viewers. If you're in that kind of unfortunate trap at this moment in time, do get in contact with either Hive or for David at Vision, and we'll build the best plan for your circumstances.
Definitely happy to have a chat.